Hello and welcome to the Weekend Investing Daily Bite of 26th of May. A nothing sort of a day in terms of volatility. Very smooth day, gradually inching up. The EU tariff thing that came around post Friday close also has been pushed back as usual. Trump is basically a scaremonger, and once the deadline comes near, he will push it back. So the world is not really bothered too much about his warnings. Today's topic is very interesting in the sense that you will see how easy and how simple is what I'm going to show you, where some consistent money can be made very simply. So that's the revelation for this next second half of the video. So disclaimer, as always, please read it fully and understand it, and do subscribe to the channel if you haven't so far. Markets, nice day. We have now recovered pretty much what we had lost in these 4 or 5 sessions right here. In the last two sessions, we are back up near the recent highs, closing at 25,000.6% up on Nifty. So I think everything is again back in the good mood market sort of a situation where there is no major you know cloud overhang on us. Any dark clouds are not there. Fiscal deficit is going to be fine now, given that RBI is giving away 2.6 lakh crores. Uh, Inflation is in control. Likely, we will have some rate cuts going forward. Results have been all right. FIs are not excessively selling. Domestic money is continuously on. So I think, and there's more focus on some few sectors given this tariff business. So overall, it looks good. Nifty Junior also up 0.4%. Again, a recent high of about 4 or 5 months. Uh, Mid caps also up 0.56%. Small caps also up 0.52%. No major volatility anywhere. Bank Nifty also closing 0.3% up at 55,500, very near recent highs, in fact, recent all time highs. Uh, and we are sort of still in that flag position where a very sharp move can now happen anytime when there's a trigger. Gold is down today, 0.92%. But again, I mean, after the run up that we have seen this year, some sort of consolidation is possibly good. The seasonality of gold is such that, going into the festival season, you will see 2, 3 months of major gain again. So I think maybe May and June may remain a bit more in consolidation phase, and then July, August, September are likely to be going up. That's the guess that I would have. Nifty 500 advanced decline ratio 321 to 175. Not very, uh, I would say, polarized towards gains, but reasonable, sort of 3:2 sort of situation in terms of advanced decline ratio. Nifty heat map reasonably green. FMCG, autos, IT stocks, steel stocks, all participating. No major red except Eternal. That top that Zomato / Eternal made seems to be an eternal top, and we are coming down very rapidly from there. Um, Moving into the Nifty has not really helped Eternal at all. In the Nifty next 50 space, we see very nice moves in some real estate stocks, Divi's Lab, Adani Green, JSW Energy, some losses in ICICI General Insurance, Indigo, Naukri, etc. Sectoral trends, once again, defense sector is at the top, 1.1% up for the day, and uh, 4.26% for the week. So defense is leading the market still. Auto space moved up very nicely today, 1% up on auto space. IT stocks did well, 1% up here as well. And FMCG post ITC's results has turned around and was up nearly 1% again. Metals also doing very well at 0.94%, and the rest were much lower. Tourism stocks were flat. Central public sector enterprise stocks flat. Capital market is flat. Now there is a lot of news about NSE IPO getting cleared in the next month or so. So gray market is extremely hot on NSE, and perhaps some focus will move away from BSE, which is much higher valued than NSE, as people say. Um, Private banks, PSU banks, Nifty banking in general, all minor gains for the day. So defense sector, yet another new all-time high at close. BEML running up 14% post results. Data patterns 4%. Solar industries nearly 4%. Dynamatic 3.3%. Unimac Aerospace. So these companies actually, a lot of people are worried that the price earnings has gone up too much, the valuation is too much, but this is such a buzzing space right now that one order, if you get, it could be equivalent to your market cap, that order size itself. So companies can resize very very rapidly in this space right now, and hence I don't think valuation watching will help much right here, although I mean we've had very high valuations on FMCG, IT stocks also many times. So, but they have worked. I don't know whether this will work or not, but uh, it does look like valuation is not the way to look at this. Autos up 1%. Bajaj Auto, Mahindra, MRF, Samvardhana Motherson, and Tata Motors all doing well today. And that makes us come to the topic of the day: making consistent money. Is this simple? So there is no question mark here, right? I'm not questioning that making consistent money is simple. I'm saying it is simple. I mean, it is a hard fact. There's no doubt about it. So let's now see how various asset allocations have ranked in the last 10 years. For equity, we are choosing Nifty 500 index. For debt, CRISIL Composite Bond Index has been chosen. And for gold, Nippon India ETF Gold Bees has been chosen. These are the most liquid, most active counters. And this is the sort of asset allocation quilt, if you may, has been formed, where for every year different combinations are there. So let's say this top one is, and you can zoom into your video if you like. This is 20% equity, 60% debt, 20% gold. This gray one is 60% equity, 40% debt, zero gold. This green is equity 50%, debt 40%, 10% gold. This light green is equity 60, debt 30, gold 10. This purple is purple, or I don't know, violet perhaps. Equity 50, debt 30, gold 20. Blue aqua is equity 70, debt 20, gold 10. And this or yellow one is equity 34, debt 33, gold 33. So roughly all equal here right now. So these are the seven combinations, and how they have fared each year has been displayed. So for instance, in 2015, the best performing asset allocation was 20 equity, 60 debt, 20 gold. The same was for 2016. In 2017, 70% equity, 20 debt, and gold 10 did the best. Then in 18, again 20 equity did the best. 19, the equal weight did the best, 33% all. In 2020, again equal weight did the best. 2021, equities were in a huge trend that they did really well, equity 70%. 22, again equal weight did very well. 23, again equity 70 did very well. And in 24, equity equal weight again did very well. So you are seeing that the top performing asset allocation for each year. If you also see the worst one, you will find that for 2024, 60% debt, 20% gold, 20% equity did the worst. And this was the same for the 3 years, 21, 23, and 24. And for 2020 and 2022, equities at 60%, option with gold zero did the worst in these last 5 years or so. So when you tabulate all this together, and these seven portfolios, seven types of allocations, and different years, 10 years of the performance, you find that equity 60%, debt 40%, zero gold has performed at 4.7 rank. Equity 70%, debt 20%, gold at 10%, which is possibly a lot of people with this sort of approach, is ranked 4. So better than the first one. Then there is equity 50% and rest is 50%. And in that rest, you have 40% debt, 10% gold. That is 4.2, which is not so far from 4.0 actually. Uh, then the next one is equity 60%, debt is 30%, and gold is 10%. So it's the same case as here, but with 10% introduction of gold, and you get to 4.1, much better than this case. Then you come to the case where equity is 50%, and rest of it is 50%, but it is divided as 30-20 between debt and gold. So this case, uh, more towards gold. You see your average score becomes 3.7, much better than 4.2. Then you have a case where equity is very low, 20% only. Debt is 60, gold is 20. So this is debt heavy sort of approach. Here the outcome is still 4. So not so different from equity 70, debt 20, gold 10. These are some very surprising outcomes of the ranking at least. And then the portfolio is there where everything is equal, equity, debt, and gold, and you find that the average ranking is 3.3. So portfolios with more exposure towards gold have returned the best performance actually. That's a surprising outcome of the last 10 years of data. So the key takeaways here is that balanced wins consistently. So portfolio with equal allocation to equity, debt, and gold has ranked the best on average 3.3. High debt and low returns. Portfolios with high debt and zero gold, like the 60D and 40E portfolio, have frequently ranked in the bottom two and showed the weakest average performance. And this has been the go-to, combination 60-40 or 40-60, so on and so forth. Then there is this thing that equity should be much higher than others. So equity heavy portfolio like 70-20-10 have both the best and worst tiers because equity is dominating the volatility, showing the ranks are sometimes very high, sometimes very, very low. And gold is very crucial. Since 2020, every portfolio with gold exposure has avoided any major losses, and those without gold have suffered at least one losing year. So that's the sort of approach, and I'll show you that table again. Is what, of course, each is suited towards a different type of an investor. You may not like to be, one third, one third, one third here, or you may not like to be 70% and 30%. I perhaps would like to be at 50-50 and have no debt. That could be another one. But this is basically telling you that different asset allocations will work in different years, and hence you need to be, you know first of all, have asset allocation, and two is also to continuously balance your portfolio so that your outcome can be good. So let me know how's your asset allocation practice, and I'll see you in the next one. Thank you so much, and do subscribe to this channel, and do like and share these videos if you like the content. Thank you. Bye.